Hello, students. So let us continue with the second chapter now. The name of the chapter is Basic Accounting Terms. So we're going to talk about the terms which we will use frequently in accounting. The first term which I'd like to describe is debtors. Who are debtors? Okay. So for this, let us understand that we are selling goods. Okay. We are selling goods, let's say for 10,000 rupees. Now, when we sell goods, we can either get money at the same time, which will mean it is a cash sales, or we can sell goods where we get cash later on, which is known as a credit sale. Okay, so these are the two possibilities. Now, when we sell these goods on credit, this person is not paying us. So let's say this person is saying he's going to pay us after 3 months. So we have sold goods for 10,000. In short, the goods are sold for 10,000 and this person is going to pay us after 3 months. So for these 3 months, this person, let's say this person's name is Mr. A. So Mr. A is the person for us who is going to be known as a debtor. Thus, who will be a debtor? A debtor is a person who has purchased goods from us or who we means the business. When we talk about we are always saying the business. So the business has sold goods, or the purchaser, Mr. A, has purchased these goods and he is saying he's paying us after 3 months. So for these 3 months, till the time he pays us, he's going to be known as our debtor. Because till that time, we are yet to get money from him, and this is a credit sale for us. At the same time, let us understand what are sales. So the second term which we will talk about is sales. So sales means sending goods or services across to a buyer. Okay, so you're sending goods. It's important to note what I'm underlining here. It is goods or services. Why are we talking about goods and services? The reason for this is because in business, we can either be a person who is producing goods or we can be a person who is producing services. So if I talk about services, we can say like a telecom service. Example, Geo. Or if we talk about goods, then we can say like televisions. Example, Sony. So Sony televisions are manufactured. So these are two terms which we will talk about when we talk about sales. The dealing or the sending of goods or services across to a buyer. Now, when we do sales, these sales, we can have them to be of two types. Which are these two? One is a cash sales and one is a credit sales. So the total sales that we make are equal to a cash plus credit sales in the business at any point in time. Now, when we do sales, there is another term which we must remember. This is called carriage. Sorry. Yes, let's say we are talking about carriage. Let's continue on that topic. So, when I talk about carriage, carriage is an extra amount which we are paying transport the goods, an amount paid to transport goods. Now, definitely, if I'm selling goods, I need to sell them from point A to point B. So if somebody comes and buys a television from me, I have to transport it from the shop till the person's house. So I'm the person who's doing business of selling these televisions. So for me, these are sales. And what is this person or what am I going to also be charged is carriage. That means it's an expense. It's an amount paid to transport the goods. Okay. So at times you will have questions saying that you have done sales and on those sales you had to pay carriage. So this carriage for you will be a kind of an expense. We will get on to this term also in a while. So just remember, carriage means an amount which is paid to transport the goods. Now, either these goods, in our current case, we are talking about the goods going out of our business because we are talking about sales, sales to a debtor, debtor because that person has not paid us up. So this whole thing, it's like a story which we are talking about. We have sold goods to a debtor and it is on credit. He will be a debtor for us till the time he doesn't pay us off. Okay. All right. Now let's come on to another corresponding term, which is called sales return. Sales return. What does this imply? So when goods are sold after selling, if the purchaser returns the goods, it is called purchase returns. Sorry. It is called sales returns. Sales returns. Okay. So we are always going to be talking in terms of the business. And for us, when we sold the goods, that is after selling, if that purchaser returns those goods back to us, those are going to be known as our sales returns. Now, sales returns has another name, which is called return inwards. Why is it called return inwards? Because the returns are coming back to us. Okay. I'll just tell you one thing you always have to remember. We are the business. So whenever we talk, we will talk in terms of ourselves. Okay. No. This I have just highlighted so that you remember this point in all the points that we are going to discuss. Now, whatever terms we are discussing here, like sales return, prior to this, we spoke of debtors, then we spoke of sales. All these terms, these three terms, And all the following terms which are going to come now, these all will be accounts. So we will be making accounts in all these names. Okay, while we go ahead. Just keep it in your mind. For now, let's go to the next term. The next term we'll talk about are creditors. So who are creditors for us? We are the business. So creditors are those people. Now I say people because it could be like we have sold goods to any person by the name X or Y or Z. So these are those people, or you can also term them as firms. When I say firms, it means any business unit. So these are people or firms, that means business units, which or who which have sold goods or services to us. And when I say us, it means the business. We are the business. And have not taken the money from us yet. Okay, so these are people or firms. That means either a single individual or a business unit itself who has sold goods or services to us. Goods may be any products, like we saw televisions, or let's say a machine, and services. A service in this case would be, let's say, a telecom service, and they have not taken the money from us yet. So these are creditors. When I say goods, and I just mentioned a machine. Now, in this case, a machine, you may think a machine is an asset for me, or in this case, what I am trying to say is a machine is a good for me. These two are conflicting. I am saying in this definition, I mean, we are talking about goods. So when I'm talking about goods, I'm assuming I am a person who is selling machines to other people after I purchase them from a person who has sold it to me. So I'm a person who's trading. And I'm trading in what? I'm trading in machines because I have bought it from someone. I'm trading this machine with somebody else. So I'm selling this. Okay. Again, I'm repeating what I mean to say over here is if I just say that these goods imply machines, this means that I'm a person who is dealing in buying and selling of machines. And here the machine is not an asset for me. Here the machine is what for me? It is a good for me because I'm dealing and buying these goods and selling these same goods to somebody else. Okay. Next. These goods or these purchases can be either cash purchases or credit purchases. When I say cash purchases, that means I've paid them, paid in cash. If I say credit, That means not yet paid. So my purchases can also be of two types: cash purchases and credit purchases. And adding these two, this gives me my total purchases. Just like adding my cash sales and my credit sales gives me my total sales. So this is the next point which we have to keep in mind. So along with creditors, we have understood purchases. Just like along with debtors, we understood sales. Now, when we talk of purchases, we have another corresponding term, which is called purchase return. So purchase returns are purchases which are returned. So they will be returned to who? The seller. So my purchases returns, or my purchases returns account, if I make, later on we'll talk about this. This will mention those return of goods made back to the seller. So in this case, we will also call our purchase returns as a return outwards, because we are returning them back. So it's going out of our business. So it is purchase returns or return outwards. Again, while doing so, we can have an expense of carriage. Carriage is what? An expense paid in order to bring the goods or take it back. You can also say it's being taken back. All right. Let's come to the next important term, which we will talk of, let's say, capital. So what is capital? Capital is the amount invested by the owner in the business. It is also called owner's equity or net worth. Okay, capital has two names, which we can call it also. It is called owner's equity or net worth. Now, how can an owner start a business? The owner can be a person, very generous. He can bring cash. He can bring goods. He can bring an asset. So if he brings cash, let's say he brings off 10,000. He brings goods costing 50,000. He brings an asset, let's say a machine, or let's say a table costing 10,000. In all, we will say the capital brought by this owner in the business is of 70,000. So this is an amount which is invested by this owner in the business. It is also called owner's equity or net worth. It is in the form of cash. It is in the form of goods. It is in the form of an asset. Okay. Next, a proprietor. Proprietor is the owner. Okay. In simple words, a proprietor by the name is called an owner. Then we will talk of drawings. So when an owner withdraws capital from the business for his own use, it is called drawings. Now you will wonder, this capital, first of all, it is brought by the owner in the business. And why cannot he take it out? The reason for this is capital is brought and given to the business. So if capital is brought and given to the business, what is it for the business? Let's say you are a person who has got some money with you. You want to keep this in a bank. Now, when you keep this money in the bank in your account, what is the bank supposed to do with this money? Whenever you want, the bank is supposed to return this money. So, in the same way, think about capital. This owner has money with him. He has taken out some money and given to the business. So, what is it for the business? The business has to give back this money when the owner wants. So, that's what is happening here. So, the owner wanted some money out of what he had given to the business. So, when the owner gave the money to the business, it was capital. When the owner withdrew that money from the business, it is called drawings. Okay. So, therefore, now drawings can also be in the form of cash, goods, and an asset. The owner can withdraw it in these ways. Okay. Next. Okay. The next term is entity. So, an entity is an economic unit in the business. Now, when I say economic unit in the business, this means capable of money, capable of money transactions, you can say. All right. So when we talk of its classification, we will say a business entity, a business entity is that which is capable of doing business transactions. So, business entity is one entity capable of business transactions. And what are business transactions? Business transactions are those which happen on a regular basis. They are done for earning profit. So, A business entity is an entity capable of business transactions. Now, which are such entities? We will have entities like, let's say, Hero Motors. What are they doing? These are companies, so they are businesses. They are doing business on a regular basis. They are doing it for what? They are doing it for earning profit. Now, there are some entities which are non business entities. So, what are non business entities? So, these are entities capable of not earning profit but rather providing services free of cost. So, which are such non business entities? These would be a charitable institution. So, sometimes you have some charitable institutions. These are entities which are not there for earning profit, but rather provide services free of cost. Okay. So, there exist some entities which are economic units, and those are there not for giving any kind, not there for earning profit, but it is rather there for giving a service for free. The next, after this, what are business transactions? We have seen this in chapter 1. So, business transactions have a debit and a corresponding credit. Okay, these are those transactions which have a debit as well as a corresponding credit. They will affect either the capital or the liabilities or the assets or the incomes or the expenses of a business. So they will affect either the capital, liabilities, assets, incomes, expenses of a business. Okay, another point. A business transaction will affect the business economically. Okay, a business transaction will affect the business economically. It means it will result in the flow of money. Will result in the flow of money. For example, purchase of goods for 10,000. This will result in the flow of goods coming into the business, and it will involve the flowing out of cash from the business. So it affects it economically. When I say economically means, it means that money is either going to come in or money is going to go out. Okay, the next term. The next term is an account. What is an account? So an account is a place where we write down business transactions pertaining pertaining to a particular you would say maybe a person or an item. Okay. So it's a place where we write down business transactions pertaining to a particular person or an item. So if we talk about how it is made, it has got two sides to it. On one side, we write debit by the name, by the two letters DR. On one side, we write credit. And here, whatever is the name of the account. Account is written in this way, capital A slash small c. So we will write whichever account's name is before the term A slash C. Okay, this is basically a T-shaped account. Okay, it is basically T-shaped. You can see it in the form of a T. The next term we'll discuss is a liability. We have already been writing few times about this term, but we have not discussed it. So what is a liability? A liability is a burden. Okay, a liability is a burden on a business. Again, we can say it is on a business or a person, and signifies an amount which is yet to be paid off. Okay. So what are some kinds of liabilities? We will talk of this in terms of the kinds of liabilities. So it is a kind of a burden which has to be paid off. And which kinds of liabilities will we have to pay off? The first is an internal liability. So what is an internal liability? When we just began this class, we were talking about capital. We were saying capital is an amount which is invested by the proprietor or the owner in the business. So this amount has to be paid back to this owner when he wants it. So for the business, this is going to be a liability. For the business, the capital invested by the proprietor is a liability. And more specifically, an internal liability. This is very important. Capital for the business is a liability. The reason for this is because the business has to pay it back to the owner. Now, whether he pays it back after 1 year or whether he pays it back after 5 years, that depends on how long this business is going to continue. So, if he's paying it back after 1 year, that means the business is running for 1 year and he's paying it back to this owner because the business is closing down, and so on. So, for 5 years, it would mean the business carried on for 5 years. What else would be an internal liability? Another example would be profits accumulated in the business. So these are accumulated profits. What will have to be done with these profits which keep on coming to the business every year? They will have to be paid to the owners. So these profits have to be paid to the owners. Therefore, it becomes an internal liability. Becomes an internal liability. The next, external liability. External liabilities, these are those liabilities to be paid off to outsiders. Now, what are some liabilities which we will have to pay off to outsiders? Last time in the first chapter, we saw who are our external users. So among them, we saw there are banks. So we can write a bank loan. This has to be paid off to our outsiders. Then we may have people who have sold goods to us but have not taken money from us, which we spoke of in this lecture. Those people are known as creditors. Okay. Who else we can talk of? Maybe money lenders, some people who lend us money, etc. So these are some external liabilities for us. Now, we can have short-term liabilities and long-term liabilities as well. So, short-term liabilities. What are short-term liabilities? Liabilities for less than 1 year. These are liabilities which have to be paid off within a year. Now, who are these people who we have to pay off? You may note it down. Creditors. Creditors are those people who have sold goods to us but have asked us to pay us the money, asked us to pay them the money within a year. So it is less than a year that we have to pay the money back to them. Another example we can write as bills payable or short term loans, etc. Okay. The next, long term liabilities. Who are these people? Or who are these liabilities for? These are when the liabilities are for more than 1 year. Example, you have a bank loan for more than a year. Specifically, it's mentioned that it is for more than a year. Or you can have debentures. These are again some kinds of financial terms which are used to raise money in a business, and they are taken for a period which is more than a year. You issue debentures and you pay them off after a year. Okay. So we'll talk about these things later on in our accounting, but just to note down some examples, we have written these. Then we'll talk of some other ways of calling these. So these short-term liabilities are also called current liabilities, and long-term liabilities are called non-current liabilities. Okay. All right. Now let's come to a corresponding term, which is an asset. So what is an asset? An asset is a business. What can we call it? It is a business term which signifies possession of an item in terms of money. It is a business term which signifies possession of an item in terms of money. All right. So this means it will be, let's say, a machine. This has some worth. It has some worth in monetary terms. That is to say, if I buy a machine for 10 lakh rupees, this 10 lakhs is the value of this machine. So it has some worth in monetary terms. And what will this machine be for me? What will this machine in my business do for me? This will strengthen my financial position. You remember? We were saying about financial position in chapter 1, and there we said we make something which is a balance sheet. So this balance sheet is also basically in this format. We write it on top, balance sheet, and over here on this right hand side we write the assets. So what are our assets? We will say, for example, machine. We will say, for example, cash. We will say, for example, debtors. So what is happening because of them? They have some worth. They have some worth. Okay. So whatever worth they are, like this, I said is for 10 lakhs. This, let's say we have 1 lakh rupees lying in cash. Debtors, let's say we have 50,000 worth of debtors. So all these, when you total it, tells you how much, how strong your business is, how much money you have in the business, how much worth of things you have costing money in your business, which if you sell, you can quickly or slowly get back some money in your business. So these are your assets. Now, under this also, just like liabilities, we classify them. So the first classification is non-current assets. Now, when you say non-current asset, this means something which will not get converted into cash easily. Some assets which will not convert quickly into cash. What are some examples of some assets like this? Example, you will say a machine, or you will say plant, or you will say land, etc. So these are those assets which will not quickly convert into cash. You have them, it is beneficial for your business, but when you want to get cash out of them, they will not be easily convertible into cash. These again, you can classify into two types. So the first of them is tangible asset. So tangible assets are those assets which can be felt and touched. So which among these, which we just wrote on the top, are tangible assets? So basically all of these which we have written here, we can see the machine, we can see the plant, we can see the land, we can touch the machine, we can touch the plant, we can touch the land. So these are all examples of tangible assets. We have another classification, which are intangible assets. So for them, we will write patents, goodwill, etc. Now, what are patents? Patents are rights. Okay. So when you want to protect your product that you make, you protect it by purchasing some rights so that no one can copy your products. So these kinds of rights which you purchase for some amount of money that you spent, these are again intangible assets for you. What is the goodwill? Goodwill is the reputation. So today, let's say you have a business which is running and you have made a good name for it. Tomorrow, if you want to sell this business, just because of its name, you can sell this business at a higher price. This kind of an asset which you have formed because of the name of your business, because of the fame of your business, this reputation that you formed is again an intangible asset. Can it be easily converted into cash? Can I just quickly say how much it is worth, or can I just ask somebody to pay me this amount and they will immediately pay? No, I cannot do that. It is not easy. It is little difficult to calculate, but it is calculatable. So these things are intangible assets. A second category which we have are current assets. So current assets are those assets which are easily convertible into cash. Okay. Now, an example, cash in hand. So a business has cash lying with itself in the office, that is cash in hand, or cash at bank. That means the business has in its account, in its bank account, which it has opened, some cash lying there. Or you can say debtors. That means the people who are supposed to pay back money to the business after the business sold goods to them. Or you can say bills, receivable. Okay. And you can also write current investments. All right. So these are some current assets. It says prepaid expenses will never be realized in cash. These are also included in current assets since the service or benefit will be available against these without further payment. So prepaid assets, they are also included in current assets because the benefit of them we will be obtaining without any further payment. Prepaid expense. These are expenses paid in advance for a service or goods you want in future. That means you've paid up for something in advance or you've paid up for a service in advance. Just like you have a prepaid mobile SIM card where you recharge your phone beforehand. So you pay for it in advance, whereas the service that you get from the service provider is in the future. Maybe for a month, you will be getting the service. So these are those kind of expenses. These are also examples of current assets. The reason for them is because you're going to get the benefit in the future time. This is again a current asset. We have another category which is called a fictitious asset. These are also called nominal assets. We will write some examples. Example, debit balance of a P&L account. Now, just to make things simple on our side, we will write this as a loss. Debit balance of a P&L account is a loss, and this is said to be a fictitious asset. Another example is advertisement. Expenditure. Why are these fictitious assets? When you talk of fictitious, it is an imaginary asset. It is something which is there, but yet it is not there. Now, why will you say so? This is because, let's talk of the second one, advertisement expenditure. It is an expense over here for us. So these expenses will actually not be shown for the current year itself. We know we show expenses in the current year, which will be uh, pertaining to that particular year. But an advertisement expense is a big expense. Can we show everything of that expense in the current year? No, we will not show. The reason for that is, let's say we have spent 10 lakh rupees on an advertisement. This ad is supposed to air on television for 5 years. So we cannot be showing such a big expense in the first year itself of 10 lakh rupees. The reason is because this is divided into a number of years. It's going to be shown as an asset for a number of years. It is going to be showing as some benefit that we are getting in terms of money for a number of years. So we will, for the first year itself, we will show an amount of, let's say, 2 lakhs. So 2 lakhs will be shown as an expense, and the remaining, which is 8 lakh, this will be shown as an asset. So this kind of an asset of 8 lakh rupees will be a fictitious asset. Okay. And this kind of an expense for us will be shown in the P&L account. When we come in our accounting, we will talk about this again. Let's go to the next term. Capital receipts and revenue receipts. When we talk of receipts, receipt is an amount receivable. So when are we receiving some amount and we are saying it is of a capital nature? A capital nature means a big amount. We will just do this with 2 points. It is a big amount and it happens rarely. So when will we get a big amount? Let's say on the sale of a fixed asset. Okay. So very rarely will you have something which is sold, which is a fixed asset, which is, let's say, a machine, or which is, let's say, land, which is sold, and you're getting some money. So this amount which is received or receivable on the sale of an asset, of a fixed asset, is called a capital receipt, a revenue receipt. This is again an amount which is receivable, but we will say it is a small, regular income happens during the year. For example, you're selling goods, sale of goods, or commission received. So all these are happening regularly in the business. So these kinds of incomes which you're getting are revenue receipts. What else? Next, we come on expenditures. Now, just like these incomes, now we have expenditures. So first of all, we'll define what are expenditures. So it is any kind of spending in cash or transfer of property or incurring a liability for the purpose of acquiring an asset, goods, or services. Okay, so any kind of spending in cash or the transfer of property or incurring a liability for the purpose of acquiring an asset, goods, or services is called an expenditure. So anytime you spend for these purposes, that kind of a spending done is called an expenditure. Now, just like capital expenditure, just like capital receipts, you have capital expenditures. So again, we will take 2 points. It increases the value of a fixed asset, and it is a big amount whose benefit we get for a number of years. Okay, so 2 points are these. It increases the value of the fixed asset. Let's say we are spending a lot of money in the business to increase the value of our fixed asset. So we have, let's say, a cinema. We own a cinema, and in that we have 100 seats. We want to earn more money. So we have installed 50 more seats. Due to this, what is going to happen? The earning is going to increase. The seating is going to increase. The earning is going to increase. The value is going to increase. Value of my fixed asset will increase. Okay. Another one, it says whose benefit we will get for a number of years. So just by increasing the seating, the benefit will be obtained for many, many more years. Revenue expenditures. These are those expenditures regular in nature and they have small amounts. Okay, so 2 points, regular in nature and small amounts. Example, salaries to employees. Again, something happening regularly, and it is in small amounts that we pay off to these people in the business regularly. So, regular and small amounts. Next. Before going ahead, let's go back to one point. We spoke of fictitious asset. These are also called deferred revenue expenditures. Okay. So we have taken this example of advertisement expenditure and we have written that it is an imaginary asset. The reason for that is, let's say we kind of make this, kind of show this in our balance sheet. So if we make a balance sheet, I just said we write assets on the side and liabilities on the left side. So when we show a balance sheet, we had given an example where we spent 10 lakhs on advertisement. So in the first year itself, we cannot show this expense of 10 lakhs. So we will show this expense in an account which is a profit and loss account. In that account, we show expenses on the left side. And in the first year, since we are saying this whole expense will come for 5 years, so in the first year, we write an amount of 2 lakhs. The remaining amount of 8 lakhs will come up as an asset here. So what is this kind of an asset which is created here? It is a kind of an imaginary asset. This kind of an asset will go away in some time. That is why it is an imaginary asset. Okay. Now let's go back to the next point. Next, we'll discuss of expenses. There are two different terms. Sometime back we spoke of expenditures. Now we are talking of expenses. So what are expenses? These are the costs incurred in producing and selling goods and services. These are the costs incurred in producing and selling goods and services. I'm not talking of acquiring an asset. That was in the heading expenditure. So here we are talking only of goods and services. So an example would be cost of goods sold. That means what is the cost of the goods which are sold? Let's say we have this pen. Now this pen will have a refill within it. This will have an outer covering. So when we manufacture this pen, what is the cost of this? It's going to be the cost of the body of this pen, plus the cost of the refill, plus the cost of the nib, etc., whatever makes up the cost. So when we are giving this example of cost of goods sold, so that is our expense on making this pen. So that is what we spoke of in the first point, cost of goods sold. Another would be salary, commission, etc. Another would be decline in the value of a fixed asset. That is depreciation. Sometime back we spoke of this. So decline in the value of a fixed asset or depreciation is also an expense for the business. Now, another term related to this is income. Amount received from the sale of goods and services is called revenue. So whenever you sell goods and services, the amount which you receive is called revenue. And we saw sometime back the costs which are incurred in finding these things out is called expense. Costs which are incurred in producing and selling goods and services are called expenses. So the excess of the revenue over expenses is called income. Okay, so these two are explained from here. The excess of revenue over expenses is called income. So you can write income revenue minus expense. Okay, income is revenue minus expense. Next is profit. Profit means the excess of total revenue over total expenses. Okay. Profit is the excess of total revenue over total expenses during an accounting period. So during the whole accounting period, when we talk of the whole accounting period, the difference in the total expense and the total revenue is called profit. We will stop here. We'll continue with this chapter again. Till then, do revise, do go through these terms, do share this video with your friends, do subscribe, like, and share this video. All the best.